Welcome back to Insights Now. I'm Brandon Hall, research analyst here at JP Morgan Asset Management. For our regular listeners wondering where David is, don't worry. He'll be joining us in a little bit, just in a different capacity than usual. After the Federal Reserve's dovish pivot in December, many investors came into this year expecting multiple rate cuts. In fact, in early January, markets were pricing in over 6 full cuts in 2024 alone. Since then, sticky inflation has caused the Federal Reserve to reassert its hawkish tone, and the outlook for the economy, inflation, and monetary policy has become increasingly uncertain. As a result of this, investors often ask us, when will the Federal Reserve begin cutting rates? To help us dive deeper into this question, I'm excited to be joined by the regular host of this show, Dr. David Kelly, Chief Global Strategist for JP Morgan Asset Management. David, welcome to the guest seat on Insights Now.
Glad to be here.
So before we talk about where we're going, let's talk about the past a little bit. Sure. We've seen growth is showing signs of slowing. Inflation, while it's been a little bit more stubborn over the past few months, has made meaningful progress from its levels of last year. Yet at the June FOMC meeting, the Fed only penciled in one cut for 2024. So why isn't the Fed ready to cut rates yet?
There are two reasons. One of them is that I really think the Federal Reserve thought the economy would be in worse shape than it actually is. And so we've seen growth in the first quarter, which was 2.9% year over year, which was a lot faster than they were looking at as a run rate. So I think that's part of the story. There seems no urgency about to cutting rates right now. And then they do want to see inflation come down in a more meaningful way. We made a lot of progress coming down from 9 to 3 point something, but frankly, we've been printing a 3 point something year over year number in CPI for a long time now. I think they want to see some more progress there. So I think that's causing them to delay. I would also say that there's sort of a change in mindset of the Federal Reserve relative to the last decade. In the last decade, they were really very dovish. They were trying to promote higher inflation. Then we got higher inflation. I think they feel guilty about it. So there are people who may, a few years ago you would have thought that they were kind of dovish. Now they are more on the hawkish side. And I think a lot of Fed governors and presidents just want to show that they too can be tough on inflation. And so, unless they get some more progress, they just want to take their time.
Yeah. So building off of that, in the coming months, in terms of the data, how do we need to see the data evolve for the Fed to feel comfortable cutting rates, and when could that first rate cut occur?
Well, I think we need to see just a little bit more progress on inflation. So if you look at their June meeting, at the June meeting they went from having 3 rate cuts penciled in for this year just down to 1. And if you assume that the meetings they would cut at are March, June, September, and December, what that really means is they left in a cut in December, but at the moment they don't think they're going to cut before then. But it's very close. There are 19 FOMC participants, 19 presidents and Fed governors who submit forecasts. And if just 2 of them change their minds by just 1/4%, you could get a rate cut in September. And to see that, I think you do need to see some better numbers on inflation. I think if we saw things like medical services or auto insurance back off a bit, so you're not seeing much inflation on the services side. And then also, frankly, some weakness in consumer spending. If we saw some signs of weaker consumer spending so that they were more confident that growth is slowing to 2%, I think that could push them over the edge. So I think it's still possible we get a rate cut in September. But again, at the moment, while the economy is healthy, the Federal Reserve is just in no rush.
Yeah. So that's what we expect this year. But if we look forward into 2025, what's your rate cut outlook there?
Well, I think they're going to try to have a pattern to their behavior. I think they'd much rather conduct monetary policy in a relatively predictable manner and not have to deal with a lot of political blowback. So I think when they start to cut rates, if they start in September and then go again in December, my base case is they'll cut in March, June, September, and December of next year. So that's 6 rate cuts in total, 5 or 6. So it takes you down from 5.25% to 5.5%, where we are right now, to possibly 3.75% to 4% by the end of next year. I think that's probably what they will do, and they will not characterize it as trying to ward off a recession. They'll say, well, look, monetary policy has been very tight. This economy probably doesn't warrant that anymore, so we're going to try and normalize policy. And I think they'll put in that context. So you could get 6 rate cuts in total. I don't, by the way, think you get much further until there actually is a recession, because if you get rates down to 3.75% to 4%, the Federal Reserve will probably want to hang there for a bit to see which way they need to pivot next.
Thank you, David. Very helpful. And if we pause for a second and zoom out and look at a more of a global landscape, over the past couple of weeks, we've seen other central banks like the Bank of Canada or the European Central Bank actually begin to ease policy. So my question is, do the actions of these other global central banks have any implications for the Fed's path forward?
They don't have a huge implication. I do think the Federal Reserve is always interested in the exchange rate to some extent. So if you see more monetary easing overseas, and particularly if you don't see monetary tightening in Japan, or if that gets delayed, then the dollar will tend to be a bit higher. And that's probably not a good thing. I mean, I know that a higher dollar reduces some imported inflation, but it also makes U.S. manufacturing uncompetitive. So I think there's a limit to how much the Fed will want to see that. So I think one interesting point is in September, the European Central Bank is meeting about a week before the Federal Reserve does. And if they cut a second time, then I think it puts a little bit more pressure on the Federal Reserve to cut, so that we're not left in a situation where U.S. rates are much higher than rates in Europe, and that could potentially push the dollar higher in a way that could actually hurt the economy down the line.
Thank you, David. I think that's all really useful context for investors. So let's actually talk about implications for investing. Through the first about 6 months of the year, we've seen the S&P 500 has done well despite a hawkish repricing and policy expectations. Bonds got off to a bit of a slower start in the beginning of the year, but have since rebounded and started to show signs of stabilizing. So moving forward, do we need rate cuts for the strong market performance to continue?
Not necessarily. What we've got is really a very stable environment, and that is actually encouraging people to double down on bets they've already made. So if the economy is doing well, we'll make a little bit more of a bet on U.S. growth stocks. And if U.S. growth stocks go up, we'll do a little bit more. And so long as the economy is just chugging along, people have a way of sort of doubling down and quadrupling down on that same basic soft landing scenario. So I think it's quite possible that could happen. But at the same time, what you're seeing is valuations getting pushed up, particularly for mega cap stocks. So I think that can continue without rate cuts. But the converse is that if we see rate cuts, particularly any disorderly cut in rates, particularly rate cuts that are perceived to be somehow trying to battle a recession that's beginning to emerge, then I think the stock market could take a very big hit. Because traditionally, when the Federal Reserve, traditionally they wait too long, but once they've waited too long, then they overdo it. And if they start cutting rates more aggressively in the face of economic weakness, they'll probably spook the market. And if they do that, then I think you could see a more significant fall-off. So I'm not looking forward to any acceleration in this rate cut pattern. If the Federal Reserve brings rates down slowly and only brings them down by 1 to 1.5%, I think that's probably the optimal scenario for markets.
David, thank you so much for your insights today, particularly in an environment in which there's a lot of uncertainty regarding the outlook for rates.
Anytime.
David, thank you for sharing your insights today. On our next episode, join David for a discussion on the U.S. economy as he explores if or when the next recession could occur. Until then, check out David's Notes on the Week Ahead podcast, where every Monday he shares commentary on the latest in the markets and economy to help you stay informed for the week ahead. For even more timely insights, you can also follow and subscribe to David's content on LinkedIn. To all of our viewers and listeners, thank you for tuning in today, and speak with you soon.